Tyler, shares of Estee Lauder just continue to march lower and lower throughout the year. We've done videos about before. You've owned it in the past. You sold it last year on concerns, and it looks like those concerns and other things are materializing that are making the story a little bit worse and worse.
I know, Jason, whenever people watch these videos, they're definitely looking for us for hair and skin related advice. But fortunately, it's only investing advice.
Let's take a close look at Estee Lauder, and then I have an alternative stock that investors might want to consider instead.
Let's do this.
I'm Jason Hall. He's Tyler Crow. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, check out our special link. You see it on the screen there. It's fool.com/unscripted. Go check out that link and you can get access to The Motley Fool's 10 best stocks to buy right now. Go check that out. Tyler, this is a brutal visual to start with, but this is the past 12 months. If we look at it just year to date, this looks like the fun part of the roller coaster that's not the fun part for investors. After the most recent earnings, stocks down more than half year to date. And compounding this is happening in a pretty good period for the stock market. What's going on with Estee Lauder right now? Led you to sell, continues to be a problem. Going forward, what do you think?
There's two things, and one of them is kind of we'll call it a macro issue, and the other one we'll call it a sort of structural issue. The first one, like on the macro side of things, for many years, Estee Lauder had leaned really hard into mainland China and Hong Kong as their major growth drivers. Built a lot of their what you could say their future on meeting the Chinese middle class where they wanted to be in terms of skincare and beauty. For the 2010s, that worked fantastically. But as we've seen in several other businesses in mainland China recently, with the kind of economic slowdown that has been going there, Estee Lauder has been no different, and they've been seeing significant declines in that business. This past quarter alone, they announced more than a double-digit decline in sales in its, they call it China International Airports in Hong Kong segment. Which, when you start, it's a segment of the business that was large enough that when you see things like that, it's going to drag down the bottom line. On top of that, one thing that I found a little bit discouraging is that revenue declines have been modest, single digits, double digits since its high in 2021. The trouble is that a little bit on the structural side, it has not been able to get its costs in line with this sales decline. If you look at the sales, general and administrative costs since 2021, they continue to climb despite the fact that sales have been tepid at best and even declining. And as a result, since fiscal year 2021, we've seen a net income decline of more than 90%. And that's just an untenable sort of situation. At least it's still net income positive, which I guess is a good thing. But when you look at it down 93%, there's no really good way to like spin that, right?
Yeah, no, you're exactly right. Again, that's a key. There's a difference between a company that's still profitable and a company that's profitable and its earnings have just absolutely collapsed, right? The China story is a big part of the reason why. And as they've tried to make changes to deal with that weakness in that market, which looks like it's going to continue to weaken or remain weak for some time, they've had to spend money to stand up operations and try and pivot. And that's really hard to do because your earnings are going down. You need to spend more money to beachhead in other markets. And it's a strategy that just seems like it's struggling to really pay off.
Yeah, and to compound the problems with the turnaround or the pivot, if you will, is that this company has a little bit of a HBO succession drama going on that has further complicated how things go. The Lauder family are still significant owners of the stock, and at the same time, they have a large say in what happens. The son of Estee Lauder was the chairman up until 2023. His and I believe it was his son that it became the executive chairman as of recently. And there has been a recent push by a separate kind of rival faction of the family, if you will, Jane Lauder, who was I think, chief of marketing or digital marketing for some of the brands. She was actually vying to be the next CEO, and with the current CEO, Fabrizio Farza, actually stepping down. And they recently named a new CEO who was not Jane Lauder. The new one is Stéphane de la Faverie. He has been with the company since 2009, and he was with L'Oreal before that. So a little bit of an internal hire with some expertise outside. But I think one of the big challenges they've had over the past several years is there's been this like infighting between the family and the executive leadership as to the direction of the company, the the executive chairman saying one thing, other significant shareholders in the company saying another thing, and it's kind of muddied the waters, if you will. Hopefully, I don't know if this is certain yet because they still have a large say in how things go, but hopefully with the introduction of De La Favori as the new CEO, we'll be able to put some of this behind us. Jane Lauder is actually stepping down from the company as a result of the naming of the new CEO. So it will be interesting to see with this new leadership change if they can actually implement the strategic changes that they need to do to fix this. In addition to that, they pulled their financial guidance for 2025. They slashed their dividend by 50% to kind of help right the ship. And I think the chances are we're going to see some significant restructuring over the next year or so.
Yeah, and I think the market's certainly telegraphing that with as much as the stock prices come down. But to me, Tyler, and I think you agree, it's kind of a wait and see moment. There's a wonderful brand. There's some great products. There's a decent amount of loyalty from consumers that do use those products, as we've seen over time. But this massive shift they're having to go through, the structural changes they're having to make. To me, I think investors would be better off to stay on the sidelines and continue watching, looking for signs that the turnaround is working before trying to catch the proverbial falling knife.
Yeah, and just to give one moment of, I guess you could say, hope or good sign is that I was mentioning sales general administrative costs. Those are so high for this business that if they can rein them in, it will flow to the bottom line quite significantly. This is a business with like 80% gross margins, but only 10% net income margins. So if we could see some sort of control at that rate and just a modest increase in sales, then there's a good chance that we'll see a large uptick in net income. But like we said, it does involve an actual restructuring, which is something they haven't been able to implement.
Let's pivot to a stock I think that might be worth considering buying right now. I want to talk a little bit about Elf Beauty here. So net sales growth continues to be very, very strong. 50% growth in revenue growth in its most recently reported quarter. It actually, by the time you see this video, probably will have reported again. So this information may be a little bit stale, but I think, again, the trend is very good. And I want to highlight, Tyler, something about Elf that I think should work out very much in its favor over the long term. And that's the international opportunity here. So net sales grew in the first quarter 91% internationally. So it almost doubled its international business. And it's got some strong stakes in a few different markets that are generally smaller markets against the global opportunity. But if you look at its total sales, 16% of its business is outside of its core North America market, compared to around 70% for most of its peers. Most of its peers have beachhead. They were founded somewhere in Europe or in the US, and they've expanded and become international successes. And so far, Elf is really early in that journey. Now, I will say, you look at the stock, and its stock is also down about 50% from its high. But even with that sharp decline, it's up around 10% or so over the past year because the business does continue to grow. We've just seen the valuation has come down because at one point it was trading for about 100 times earnings. Earnings is still growing, but very few stocks ever deserve to be worth 100 times earnings. Even with the stock having come down as much as it has, it trades for about 50 times earnings. At their ability to continue to grow and take market share and get that operating leverage you were talking about that you can get with the high margins you get in beauty, I think 50 times earnings is certainly, to me, if not time to buy a whole position, certainly maybe think about opening a position and follow it as the growth story plays out. But when you have a growth story that's working, earnings are growing, things are moving in the right direction. Whereas, like I said, with Estee Lauder, there's a lot of reasons to kind of wait and see. It could turn into a value opportunity down the road. But to me, I think between the two, Elf is the one that I would be thinking about buying right now.